Welcome back to this channel for practice problems for actuarial exams. This is a problem for exam MLC for August 5th, 2017. You have some links to resources about me and about study manuals that I wrote and online seminars that I run, and about the actuarial program at Illinois State University. Please use them, look things up. So here's a problem from the last exam MLC, problem number 17, in multiple choice section. You are conducting a profit test on a fully discrete 3-year term insurance policy of $1,000 issued to 55-year-old. Some details of your profit test calculations are summarized below, and you have the policy year, starting reserve for each policy year, gross premium for each policy year, expenses. You see the expenses are unchanged, they're always 20, gross premiums are always 75, investment earnings increase 286 and then 9, expected death benefit. So notice that this expected means that it's subject to probability of dying in the given year, and expected cost of reserve, and that's subject to probability of surviving in that year. And then you are given the probability of dying at ages 55, 56, and 57, which matter for these calculations. You're also given that the pre-contract expenses are 100, so that's expense that happens when you set up the policy at the very beginning. There are no lapses, and the hurdle rate is 10%. Hurdle rate is the rate used for discounting of profits, because it's called a hurdle because this is the hurdle you need to overcome to pay the investors who provided you with money to run the company. You pay them with profits, and this is the rate that they expect to be paid. This is your hurdle that you must overcome. Calculate the net present value of this policy. So net present value is calculated based on the profits generated by the policy. Note that the policy ends at the end of year 3, as the expected cost of reserve is then 0. So the standard formula for the profit calculation in policy year is the profit is the premium plus the initial reserve minus the expenses that are paid at the beginning of the year, plus interest earned on the money, minus the expected cost of death benefit, and minus the expected reserve at the end of the year. In this problem, however, investment earnings are stated as an amount, not interest rate. So if we write I for them, we can write this formula also as premium plus reserve, initial reserve, minus expenses paid at the beginning of the year, plus investment income minus expected death benefit minus expected next year's reserve. Note also that PR0, profit at time 0, will be by definition the fixed policy setup cost as of time 0, taken as a negative profit amount. In this problem, the pre-contract expenses are 100, so profit at time 0 is negative 100. Then for the first year, the profit for year 1 is 75 plus 0 minus 20 plus 280 minus 100 minus 64.35. And this ends up being negative 1655. This profit value is at the end of the year because it includes investment earnings for the year, which were 280 in this case. The negative 10 is the death benefits paid out, and you subtract the expected value of the reserve as well, 64.35. And this is not conditional on survival to the end of the year as well, as it also includes the expected death benefit. So you're doing the calculation that includes the payment of death benefit and keeping the reserve. Its expected present value at time 0 is calculated using the hurdle rate, so the rate applicable to profits. So it's negative 16.55 times 1 over 1.1, the 10% rate used for discounting. And that's a negative 15.05. For the second year, we have new values of the investment earnings, death benefits, expected death benefit, and expected reserve, and the profit ends up being negative 12.13. This value is conditional on survival to the end of the first year, but not the second year, because you see you have death benefit or reserve for the second year. So its expected present value at time 0 is negative 12.33 times the probability of survival during the first year, but not during this second year in which we're doing the calculation, but during the first year for which we already did the calculation before. Because we're only doing this for a policy that survives the first year, otherwise it's not there. And since the value is calculated at the end of the second year, we need to discount it back over 2 years. So what we get is negative 9.92. For the third year, profit is positive this time. Notice that the expected reserve at the end of the year is 0. Policy ends. So we have 75 plus 125 minus 20 plus 9, the investment earnings, minus 21, the expected death benefits, minus 0, the expected reserve, and ends up being 168. Its expected present value at time 0 is calculated by discounting over 3 years by 10% hurdle rate. And also notice that we make it subject to survival of the first and second year, because only for policies that are still surviving the first 2 years we do this calculation. And that ends up being 123.08, and then we just add up all the present values of negative 100, negative 1505, 15.05, negative 9.92, and positive 123.08 to get the final answer of negative 1.89 as the total expected present value of profits, which is the value of the policy, and that's answer B. Please remember this is copyrighted material. Problems from past Society of Actuaries examinations belong to the Society of Actuaries and are reproduced with permission. Good luck in your studies and good luck on your test.